All right, if you're a business looking for another business tax credit, I have another one I'm going to walk you through here today. And at the end of the video, I'm going to show you a quick bonus tax credit as well. So there's going to be two tax credits shown in this video. This one relates to retirement plan contributions that businesses make. So this is kind of like part two of my series. The previous video I made was the startup costs tax credit associated with setting up a retirement plan. So if you have any questions after watching this video, let me know and I'll be happy to answer your questions. Thanks again for watching.
All right, so here's the second video in my two-part series on employer retirement tax credits to businesses. So in this one, I'm going to talk to you about the employer retirement plan contributions. So these are contributions that the employer makes to their employees' retirement plans. So as a refresher here, and I updated this slide from the last presentation, is to kind of go over the difference between a credit and a deduction. So here's a business. They're doing a revenue of $1 million. They have expenses, which in this example, all of them are deductions for tax purposes of $950,000 for net income of $50,000. The tax rate here in this example is 21%. So the income tax that's due is $10,500. But there's a tax credit that's available. So instead of paying the $10,500, this tax credit reduces this amount. So now the amount that they have to pay the IRS is $5,500. That's a tax credit. So if the tax credit was $5,000, this is how it impacts the income tax due. Now just say the company has an opportunity of they found a $5,000 tax deduction. So $1 million of revenue. Now their deductions go up by $5,000, right? So they're $950,000. Now it's $955,000, and that reduces their net income by $5,000. Tax rate's still the same. Income tax due is less by about $1,000. But look there's no tax credits. So you can see the impact of a tax credit versus a tax deduction. Tax credits are always more valuable than a tax deduction. So this applies to businesses and individuals. So if you ever see, news out there of tax credits, your eyes should be wide open and try to take advantage of this. So again, this presentation, we're focused on the tax credit. So as part of the Secure Act Secure Act 2.0, they created this tax credit available to employers making contributions to a 401k plan, a SEP plan, a simple plan for the first 5 years of that plan. Okay, so if you're 20 years into the plan, you're not eligible for this credit. Okay, however, I do have a bonus in the last slide of this presentation. There is another tax credit you can take. The employer must meet the eligible employer requirements that I talk about in my previous presentation, the startup tax credit. So you gotta meet those criteria. And the maximum limit per employee is $1,000. Okay. And eligible employees are defined as those that do not earn more than $100,000 a year. And this retirement plan contribution tax credit applies to companies with less than 100 employees. So if you have 105 employees, you're not eligible for this tax credit. So here are kind of the baseline requirements here that you got to meet. So let's look at a company with less than 50 employees. And I'm going to show you an example after this slide. But essentially the tax credit, the first 2 years, it's 100% of what your contributions are to the employee. Okay. So that's the first 2 years. Second year, the tax credit is 75% of what you contribute. The fourth year is 50% of what you contribute. And the fifth year, the last year, the tax credit is 25% of what you put in. And again, any uneligible contributions here, you could still use as a deduction. So if you can't use it for the credit, you can still use it for the deductions. But remember, credits are more valuable than deductions. So that's businesses less than 50. I'm going to show you an example here, a real life example. So a business starts a 401k plan in 2023 and it has 12 eligible employees. So these are 12 employees earning under $100,000 each. Okay. The business matches each employee at least $1,000 per year. Okay. And that's the max, the credit per employee per year. So in this example here, the credit that the business is going to get this first year, so they have 12 eligible employees, those earning under $100,000 times $1,000 per employee, that's $12,000. So that's $12,000 credit that this employer is going to be able to get. Year 2, next year, 2024, same scenario. They're going to get full credit of the $1,000 per employee. So now, over 2 years, this company has gotten $24,000 of tax credits. In year 3 here, it's going to decrease. So they still have the 12 employees, and they're matching at $1,000 per employee per year. You take 75% of that. So 75% of $12,000 is $9,000. Okay. In year 4, it's 50% of $12,000. Now I'm getting $12,000 again is 12 employees times $1,000. And again, where the $1,000 comes in, it's the max that you can get, but this employer made the max every year of at least $1,000. And then the last year, the 5th year here, you take 25% of $12,000, and that's $3,000. So over 5 years, this employer is getting tax credits of $42,000, which is amazing. Now, what if you're an employer with, employees between 51 and 100? You kind of work off of a sliding scale here, and it gets a little complex, and I'm going to walk through an example for you. But essentially, the first 2 years, you take 40% of another percent of the number of employees beyond 50. So just say, and I'm going to show you an example, and it's probably easier to kind of skip here. Let's go to the example here. So this company has 60 employees, and they match it, $1,000 per year. So for year 1, they got 60 employees, you times it by 1,000, so that's $60,000. That's your starting point. But then you got to come up with this percentage here. And remember before, if you have less than 50 employees, it was 100%, 100%, 75%, 50%, 25%. That was just kind of like flat. That's part of the rule if you have less than 50 employees. But when you have more than 50 employees, there's a sliding scale, and you got to calculate your own percentage based on how many employees you have. So in this example, they have 60 eligible employees, again, earning under $100,000. To get to this 80%, what you do is you take how many employees you have, so 60 less 50, so now we're at 10. You multiply 10 by 2%, so that's 20%. Then you take 100% less 20% is 80%, okay? So you got $60,000, right? 60 times 1,000 times 80% gets you $48,000. And you kind of take the same exercise and you go through each of the years. And in this example, they come up with $168,000 over 5 years, which is amazing. But they have more employees. They're spending a lot more, so the credit's going to be a lot more. So that's this one. And then the bonus credit here is if you automatically enroll, if you do this automatic enrollment feature with your plan, every company, whether it's a new company or an existing plan, and your plan's been around for 18, 20 years, you're eligible for this $500 credit. Again, it's not a lot, but it's automatic, or it's something. And there's some requirements is your company has to be less than 100 employees, and it must meet the eligible automatic contribution arrangement requirement. So that's this. Let me know if you have any questions. But the first video I did, the startup tax credit, and then this retirement contribution tax credit. These are great credits for especially early, startup companies or companies that never had a retirement plan and now they're getting into it. This is just, these are just really nice benefits that you don't want to give up here. Again, any questions, leave them in the comments below. Thanks.